Unrivaled Nation, it's that time again, the moment you've been waiting for, to go over the monthly update, to go over my entire portfolio, as well as the history of the prior potential multi-baggers, the monthly potential multi-baggers that I call out. So those two prongs, portfolio update and the potential multi-baggers that are updated each month. So, what I'm going to do is go through first my performance, my exposure, so you can get a feel for how I'm positioning my portfolio. Then go through each of the top positions. I will have a Google Sheet as usual that's updated, refreshed each month for my top positions, thinking about the risk reward for each of these holdings. Then I review the past potential multi-baggers, as well as some macro thoughts as well. So let's go right in. So first, since inception of this Unrivaled Investing journey, it was officially launched in January of 2020, and so it's up about 61% since then. Year to date 2021, it's up about a little over 11%. That number is going to bounce around. Earlier in February, it was up 21%. Like today, it was up another like 2-3%. And so like the figure is going to bounce around. That said, I think the sort of takeaway here is that it is really sort of about my exposure, where I'm not really guns blazing, with that. And that's, some people could say, wow, Daniel, you could be doing a lot better, with your upside potential. But the reality is I think I'm doing this with relatively low risk from my own personal journey, and that's just how I like to play it at this point. Where people are getting really frothy about, meme stocks. I want to be a little more conservative. I did talk about that in several, stock market commentary videos about where we are on the journey. So I am conservatively positioned. Right now, about 60% of my portfolio is in long stocks and warrants. So obviously there's a large cash allocation, of which my top positions are about 45%. So the vast majority of my portfolio is in the top 10 positions. Now this does include warrants and stuff. I have gold that's about 2%. And then I have shorts and hedges that were about 8%. Now these are triple long hedges, and in the PDF of the full portfolio, breaks out, it's TNA and UPRO. So those are triple levered vehicles that should go up 3x or down 3x. I like the asymmetry of that, such that if you do have a very sharp drawdown of, let's say, 25-30%, that's something that it's very hard to recover from. And so that's part of the reason why I use those hedges. And relative to options, the cost of borrowing is very low versus the time and premiums that you have to pay with options. So all in, that's around 8%. So my net exposure, when you're looking at 60% long and thinking about this as triple, my net exposure is really only 30%. Now keep in mind, these hedges will fluctuate, and most of February it was closer to zero. So I'm still pretty pleased, given that my returns so far have been driven on fairly low exposure. I could see myself, if the market, if I were to see a bunch of things that were really cheap, and I were to do an updated, like, hey, this is where we are on the journey, and I'm seeing a lot of things that are sort of in a bloodbath, and I'm seeing things where it's like, hey, there's 500% upside here, and the downside's de minimis. I could see myself 120%, 110% invested. But that's just not the case right now for me personally. Maybe that's a mistake. That's why it's my personal journey. You folks have to make the, what's the right call on your own personal journey. And as I've mentioned several times, the hedges, I could change that completely overnight. It's largely based on price action. And I did a post on how there's potentially a new narrative that could come about, but I'll talk about that a little bit later. If you want the full download, I did a video called, I think to understanding narratives, and that's I think that goes into much greater detail. But this gives you a broader sense of my exposure as well as my net returns. So then for my own personal portfolio. So then you can see the top holdings here. Things largely don't change that much. Things will move around a little bit, but overall, if I like the situation, if I like the setup, and I like the, I like the valuation, I'm not going to be changing it. Now, if the valuation goes up 100% in a month, I'm probably going to revisit it and say, you know what, the risk reward may not be as compelling. And so you could see, how each of these things are, and it is particularly top heavy with C in the top, about 9% of the portfolio. It's worth calling out that C was originally just about a 2% position for my portfolio, and the reason why, it's now 9% is because this is my goal with finding potential multi-baggers, is find something that I can make a few percent of my portfolio, 2, 3, 5%, and just sit on it and let it compound and let it do its thing. And I haven't sold a share of C as far as I remember. And the goal is just to let that one compound. Whereas, in other situations, if it goes up 100% in a month, that's all valuation gains, and you need to start recalibrating. Well, wait a second, would I be willing to underwrite it again at this price? Especially if I don't have more data. And I'd argue that's sort of what happened with several of my potential multi-baggers, is they went straight up based on, valuation, people going rah, but I'm like, well, wait a second, there hasn't been any new data that would warrant this. So you could see the overview of these names, and I'll go through each of these in a moment. You don't see YY here, but that's one of the warrants, and that's about 3.5% of my portfolio now, so arguably my number 6 position. Why the small positions? If I were to find things where it's like 200% upside and de minimis downside, or 5-10% downside, then it's a bigger position. But when it's like 100% upside and 30% downside, it's going to be a smaller position. That's how I think about portfolio allocations. Unless I can start thinking about the probabilities differently and say, well, the 100% upside scenario I think is way more probable than this downside scenario, in which case, then I might make it a bigger position. So C, I still think I did a video on it on YouTube originally that has the full deep dive. I did an exclusive follow-up in Journey that you can also see as well. But even despite the run-up, it was a fast-growing company, and so that's the reason why I've held on to it. Is I notice, for example, this is the perfect example of what I want to find. I actually love it when the share price doesn't go anywhere for 6 months or a year, and the company puts up fantastic growth, because that means the valuation's coming down during that time period, and that's always a juicy setup, potentially. And so, this is the types of things where I'm looking for, where companies that could just keep growing and the valuation came down. Now, subsequently the valuation has expanded significantly, but it's still what I think of as an attractive risk reward. This is based on today's price, I believe March 1st. So still, very reasonable risk reward. In the sheet, you can play around with this assumption yourself. Look, the price will be volatile, and that'll obviously impact my own personal journey, how it performs with fourth quarter earnings later this week. Issuer Direct, my second largest holding. I like the CEO. I think he's a shrewd capital allocator. As I mentioned last month, he did a podcast where, he talked about his competitive position, and he felt like, look, he sleeps really well at night. He's very thoughtful about his employees. And I just like the setup. I like, he strongly thinks they could double the business within the next few years. He's a no BS CEO. He has a lot of skin in the game. It's like 95% of his assets. This is what he's thinking about. And, so I'm penciling out a reasonable growth rate. They have a large amount of cash relative to their balance sheet, 80, or relative to their market cap. And so all it takes, if they're able to do a transformative deal with that, then this could easily re-rate much higher. And meanwhile, they think they can organically double the business within the next few years. So, I'm not even baking that in my low case. I'm only giving 7% growth. And honestly, it's been a mixed story, because they've sort of had this legacy business dying off while they've significantly grown these other segments. And so that, I'm impressed. I'm impressed with the CEO. I'm impressed with their capital allocation, where they issued stock when it was expensive, bought pretty much back the exact same stock within like a year or two later at like half the valuation, which reflects the shrewd, management style. So overall, very impressed. Let's keep going with. And, for those folks that are tuning in for the first time, Issuer Direct, they really have like two separate segments. One is like a compliance, like SEC type compliance, investor compliance for companies, both public and private. And they have this super fast growth AccessWire business, which is effectively newswire business line, and they're one of like 4 major players in it, and they're competitively priced, and they're saying, hey, if you could link in your newswire business, this AccessWire business, link it in to your compliance business or whatever investment functions you have, that could be a really dynamite setup, and we think they can take share, and they have been taking share, because at the end of the day, the press release industry isn't growing double digits, but they're growing 20-30%. Last year I think it was around 30%, and plus they've had very good growth, and the CEO Brian Balbirnie, he's done a fantastic job executing over the past decade, so I think he can continue to do it. Then Biosyent, this was my December potential multi-bagger, so you can see the full video on that there. Look, it's not as liquid as a company like SAII, but still it trades enough that I've, built it up to be a material position for my portfolio where, look, if you want, to acquire a position that's worth tens of thousands of dollars, I think you can easily do it with Biosyent. I primarily trade in the Canadian exchange, so it's RX on the Canadian exchanges. So I bought some during January, I bought some more in February, as management has articulated that they think they're going to be teens level growth over the next few years. I think they even bought a little stock themselves, and I think you're probably going to see some growth acceleration in 2021. That's at least what I expect to happen, and I think the risk reward dynamics are pretty attractive. Given that they have, once again, a quarter of their market caps in cash. Management thinks they can grow teens rate. I do 5-10% on the conservative side, 18%, let's say, assumes they use this cash to hype up their growth over, let's say, the next 5 years. So I don't get any benefit for this cash here. But then, when I'm in this case, I'm adding back the cash to the valuation. I do 12 times multiple on their earnings, 15 times here, and 20 times because people get more excited about their earnings growth potential. But meanwhile, look, management also has been very shrewd about capital allocation in terms of buying back stock. And so, it's 4 to 6% annualized return based on the current price. Just them buying back shares at when it's compelling to do so. And I think in about an 18-month period, they bought back 11% of the shares outstanding. So, when it's cheap, they Renee Gorham buys aggressively. JD.com, I've talked about it, in several of the prior videos where, look, this is one of the dominant e-commerce platforms in China. I really, respect the fact that it has this sort of premium brand where people trust the products. And, as long as you have people looking to be middle class or upper class, you're going to want to have people buying brands that they trust. And so that's, at the end of the day, why I made JD a much bigger position than Alibaba. One could argue, hey, this risk reward doesn't look as compelling with negative 34 versus upside of 111. I would counter that and say, well, my optimized margins are possibly really conservative, because they think longer term their margins are closer to high single digits, and that might just be the case. So if you're looking at 7, 8, 9% here versus 3.5% here, that completely changes the thesis in terms of the risk reward. So I definitely keep that in mind when I'm looking here. So far they've only shown closer to 3%, but I've got my eyes wide open here to see what happens. They've definitely been showing off some of their segments, subsidiaries, in terms of doing spin-offs like their logistics and their JD Health segment recently, both hyper growth segments. Previously I had announced 2 separate SPACs that I bought at slight premiums to NAV. I still own one of them, one of which was SAII. They had previously done a deal with CuriosityStream. I didn't like the deal that they announced. The stock popped about 5% within 2 weeks. I thought it was a little too speculative, so I blew out of it. I haven't touched the Oaktree B shares. At the end of the day, I like Howard Marks. He seems like a super principled guy. This vehicle is within the Oaktree home, and I think they'll find another company like him. So that's what I expect. That said, I do think the risks involved with SPACs have gone up because there are more competitors. So in the odds of, let's say, not finding a deal have gone up just because there are so many people looking for deals right now. Joyy, or YY, Baidu said pretty much the deal's going through, terms unchanged. The CFO, so that's obviously a huge positive. I've done videos on YY on YouTube, as well as several exclusive follow-ups. YY was actually my November potential multi-bagger of November 2020. I've done several videos following up on that. It's a simple, it's a story that has multiple different parts where you're getting this huge cash infusion from selling a domestic segment to YY. They own shares of Huya. They have a lot of cash, and they also have two international fast-growing apps, Big O and Likey, and based on that, I suspect the risk reward is fairly compelling, and that's, but it's been a really volatile ride. There was a short report that came out on it where it was down 30% in a day, saying there's no way this deal goes through. Now management saying, look, the deal's still going through and the claims of fraud are ridiculous. And I ended up swapping my stock for long dated options, so that way I sort of lowered my dollar exposure while capturing the same upside exposure. And so, since then it's been working out, and I'd love to see the deal close. That said, there has been I would say increased competitive risk as you see more and more social media apps sort of tapping into the, hey, can't we just create some sort of site where people just go to socialize, whether or not it's audio or video. And so seeing Clubhouse and Twitter Spaces sort of get traction, I'm sure Facebook will launch their own iteration. It does sort of create the risk that it takes the wind out of the sails for their Big O segment, and that is a big part of this thesis still. That said, it's about 3 to 4% of my portfolio, about 1.5% at cost at the options. So the options have worked out fairly well. Zooplus, look, it's a slower growth, lower upside name because of that slower growth. And I would say fair valuation right now. They're the number one e-commerce player for pet supplies in Europe. I think they continue to grow at a good clip. They have several initiatives like their private label brands that are growing at like 25-30% a year, which is very profitable. And so I look at this, and same sort of structure as I do with all these. This had been one of my largest positions, largely because at the start of last year, start of 2020, when it was trading around like 80 euros a share, I just thought it was really cheap, and I thought it could easily double. Since then, it tripled effectively, or it did a 3x, going from 80 to 240 last month. And at 240, I trimmed it significantly. I trimmed it prior to that as well. Management bought a little bit of stock, which I think surprised the market. Honestly, a lot of this is sort of surprising to me of how much upside it's continued to get. Otherwise a sleepy name, in my opinion. So I actually bought a little bit more last week after it sold off from 240 to 200. I'm not planning on completely blowing out of the name. It's just when the risk reward is less compelling, then I'm going to sell some. And at this price, around 200 euros, I still think the risk reward's pretty compelling. It is a slower growth name, and so I'm not pushing it. Also, I give the management slightly lower marks in terms of capital allocation, because I think it would be better for them to push the growth versus try to manage their balance sheet for profitability at this stage, because it's better to get as much scale as possible, in my opinion. Mercari, this was my February potential multi-bagger. They reported, during February, they reported fourth quarter calendar year results. So for December ending, December 2020 quarter end results that, year to date for them. So that's a 6-month period for their fiscal year. It was like 46% revenue growth. So still posting very strong growth. And honestly, if you want the full download on Mercari, I'd go to the video that I did as my Asian, I think, e-commerce play. It's a consumer to consumer platform. I think it's potentially a counter-cyclical play as well, as if which is something I always like to keep in mind, which is if things start going poorly, how will the underlying fundamentals of the businesses fare? And I strongly suspect that in the event that people need to still buy stuff and it's a tougher economy, they're probably going to be buying secondhand goods on platforms like Mercari. And they've been crushing it in Japan. They've been growing at 100% in the US. So everything seems to be working out so far. Continue to track how that does. So far I'm down about 10% on the name. GoodRx, that's a position that I started off a teaser position. I did a full download on YouTube. I started off with a teeny tiny teaser position, bought some on weakness. It's a single, it strikes me as this really strong value proposition, as both consumers and physicians love it. When I look at any sort of telehealth or medical play out there, I always think about regulation. How much could it get impacted by regulation? That's something that I also thought about with HIMSS, where HIMSS would probably get more impacted for something like GoodRx. But I suspect GoodRx is part of the solution. They have clear scale advantages, so even if competitors like Amazon announce that they're interested in getting in the space, it is tough for them to offer the same level of discounts that you get with GoodRx, and so far that's at least the data I've seen. So I think, once you get scale, it makes it actually easier for you to grow even faster, because your scale sets you apart even more. Good chance that their growth accelerates as people start going back into pharmacies this next year. I like the setup. I like management. I like that it's a cash flowing company. It's just pretty rich valuation. And that's the reason why it's not a super large position. If the stock were to fall back into the 30s, I'd probably consider adding a lot more. So I actually did trade a little bit of it in February, where it went to like the mid 50s, and I trimmed just a little bit, and then it went back down close to my price, where it's here. What is it? It's about 10% above my cost basis now. So it's, I could add that back if I want to. At the current price, it's more compelling than it was in the 50s. Overall, I'm not going to be changing it dramatically. Sometimes I do a little trim if something goes up like 40% in a month. But still, I'm going to hold the core position that I put on in this, which is about 2.5% right now. So then CDON, that was my most recent potential multi-bagger, the European e-commerce play. The company has been around for several years, but their third-party marketplace is actually fairly new and in early stages of proving their ability to take share. For example, they grew their GMV, or gross merchandise value, by 86% last year. So growing 86% does reflect, in that third-party marketplace, does reflect that you do have something special with your value proposition, in my opinion. The question is, am I being too conservative with implied growth rates for the years ahead? And does that assumption result in lower potential returns longer term? And am I just being way too conservative here with this 35%? I don't know. It's a little too early in the story to tell. I trimmed the position after, I called out that it was going to be my potential multi-bagger. The stock dipped. And then at the end of the week, a sell-side analyst came out and said, look at this. This stock's worth at least 50% more. And literally the stock shot up 50%. And so 50% in a day or two. And so, when I saw that, it's obviously less compelling if you have a pure valuation change like that versus underlying fundamentals driving it. So that's part of the reason why I did trim a little bit after that sell side report, came out, as I felt the risk reward wasn't as compelling. But I'm still going to hold on to it because maybe my assumptions are too conservative. Maybe they post 40, 50% growth over the next, 4 or 5 years. We'll see. We'll see how that plays out. Right now, it's 1.5% of my portfolio. So then, if we do an overview of my, so that's an overview of my top 10 holdings. Now an overview of the potential multis that I've called out. So let me shrink myself down a little bit. So, just going through brief history, I've done Skills. You can pause the screen and read this if you want. Skills 40% gain. I trimmed significantly after they announced customer concentration risks. I simply just don't want to partner with folks where I feel like, they're not going to tell me stuff in a upfront way. And then I trimmed a little bit more, 35.70, so nearly a 200% gain. HIMSS, I bought around 10.40, around that. I trimmed half my position after about 50% gain and trimmed most of the remainder. So I trimmed, I think, less than half the position for about a 50% gain, and then trimmed the remainder or most of the position after about 120% gain. And this is just a function of like, look, the valuation changed so significantly in just a month or two. I don't like the higher tax implications for it, but I would rather have a story where I'm just holding on to it while I watch it compound. Whereas if it doubles and then it's going to be dead money for the next 5 years, or it's going to be a suboptimal return from that price point for the next 4 or 5 years, I want to revisit what it is, especially given the fact that it was all driven off of speculative fervor. I mean, there were other YouTube channels that were getting in on it, months after I had called it out for Journey subs, saying, "Hey, you should buy this." And I thought, I was like, really? You're pounding the table at double the valuation that I thought was compelling? Okay. The warrants worked out very well as well, about a 7x in a couple of months. So that was a nice contributor to the portfolio. Look, it's nice to have these types of wins, but I'd rather have the longer term win, like something like C. I've already mentioned, like, I want a long-term compounder. That's what I'm looking for. But if you are presented with a situation where it does go up dramatically, I think you have to reassess the risk reward. Maybe you don't sell the whole thing, but you can trim it. You can balance it. That's how at least I think about it. And look, you might get another bite at the apple if it goes back to your original price point. And look, a lot, like with HIMS, like everyone's pricing this off the same data, like, which goes through the third quarter. As far as I don't think they've done fourth quarter. And so no one really knows what their growth rate's going to be in 2021. I've done several videos on HIMS where I thought, maybe they're potentially sandbagging, but who knows? If their growth is 30%, maybe I get another bite at the apple. So it's a big question mark. In terms of that, I would love to see, at the end of the day, fundamental execution for HIMS. My other potential multi-baggers, YY, I've already called it out, very super volatile. The options are now up about 150% on some deal confirmation news. I haven't touched the options. So since I did the equity for option swap, which lowered my dollar exposure but kept my same sort of upside exposure, I haven't trimmed it, and I'm eager to see what their fourth quarter results look like and sort of what they're guiding to for the year ahead. And also, obviously, the deal going through where they're selling their domestic assets to Baidu. Obviously, that needs to close for this to work out, in my opinion. Biosyent, that was my December 2020 potential multi-bagger. Stocks up marginally on insider buying and new products announced. I've already talked about Biosyent. It's one of my top positions as well. Not really much else to report there. Okay, so, FSRV, Catapult, that was my January 2021 potential multi-bagger. Originally, I thought, hey, this company has hundreds of % upside. And, I still do, to the extent that, hey, they execute and things work out. But, they announced on a Friday night that they have a huge customer concentration risk that wasn't disclosed in the presentation. So at that point, I pretty much blew out most of my stake, going from, I bought it around 1320, sold most of it for only about a 20% gain. So that's obviously, not what I'm looking for, but I'm also not looking to be effectively misled by management. And so, I've actually today, I subsequently blew out the last little bit of the equity, but I still own, what I ended up doing was swapping the stock for the warrants, because it's sort of like, hey, if this, if the story still works out, you can capture a huge amount of upside, but there is this blow up risk. So why don't I limit the dollar exposure in my portfolio? Very similar thinking to YY, where it's like, hey, maybe there's a blow up risk I wasn't aware of. Let's swap the stock for equity, lower my dollar exposure while capturing a similar upside. So that's why my main position here is with the warrants. And that's it. I have seen more risks with sort of competitors sort of launching. There's a SPAC that's trying to compete with them. I look at I think it was Moneyline, which was FUSE, which is another SPAC. So I think there's one SPAC, FGNA, then another SPAC, Fuse. They're both, I think, going in the buy now, pay later aspects. And so, I think you're seeing more and more players willing to compete in the space. That did, sort of temper my expectations for them. And so right now it's just the warrants. If they're able to continue their hyper growth, then they should win handsomely. If there's any risks with competition or Wayfair, then I've effectively risked 0.5% of my portfolio. And look, I'm very mindful that can be a complete donut. That could be a zero in 5 years. So that's part of the reason why I positioned it accordingly. With Mercari, that was my February 2021 potential multi-bagger, as well as CDON, where I've already discussed Mercari, 3% equity stake going quickly and down about 10%, and CDON I already discussed as well, about 2% equity stake. Price did appreciate fairly significantly. I want to see them execute, and so this is just about holding these stakes and watching the journey. I mean, that's the part that I love, is every few months getting these updates of seeing how these fast growers are doing. Did I pay a reasonable price? Are they still growing at a good clip? Is their value proposition getting stronger? Is it getting weaker? So other news today. So the portfolio update in the PDF goes through the end of February, but I did some transactions today as well. So I just want to call it out. I did buy a little bit more Facebook just because I think the risk reward is pretty reasonable. It's not the best risk reward, but I think it is pretty reasonable. Where I'm taking what I'd argue is pretty conservative assumptions of 7 to 13% growth over the next 4 years. They grew about 19%. In 2020, I think that figure's about right. Actually, you know what? This probably needs to be updated. I think it's a little bit more than that. Where it strikes me as a attractive risk reward. They're a strong cash flowing company, so it's not like a lot of other companies that sort of took it on the chin when rates started going up. Like, oh my gosh, like this isn't a cash flowing company. This is a cash flow behemoth. And at the end of the day, there's a lot of uncertainty around regulation. There's uncertainty about user growth. But at the end of the day, they dominate customer acquisition, top of funnel for many e-commerce companies. And so that is just a super valuable position to be in. And that's why I ultimately increased the stake, is just because the stock really hasn't been going anywhere, but it has been growing by about 20%. And the question is, can they maintain that position, that super valued top of funnel position for all these businesses? And they've announced several initiatives and sort of moving into the e-commerce space with Shopify checkouts. I think there's a lot of potential there. So in the Facebook sheet, I'll update it for the 2020 figure. So as I already mentioned, I sold my remaining Catapult or FSRV stock. I still have the warrants. At the end of the day, if I'm taking on blow up risk, I might as well structure it for more upside potential while limiting my dollar exposure. And so that's the reason why I don't own the equity, but own the warrants, which give me 4 or 5 years, and can capture, like, hey, if you execute on it, the warrants should deliver. I did today buy a teaser stake in SFTW. I recently did a video on it on YouTube. At the end of the day, there's a real chance that it's an unrivaled value proposition. It's too early to tell. I like partnering with Peter Thiel, especially if he's buying around the same price. That said, it's only a 0.1% position because I want to see them execute, and it's going to be a huge cash burning situation. When you see situations like this that are such huge cash burn, there is the chance that you are able to get another bite of the apple at a much lower valuation. So I'm mindful of that with the positioning size. And with my hedges, I also increased my hedges today. Once again, with hedges, they're lower conviction. One needs to remember 60 to 70% of the time, it just won't work. They're generally shorter duration, and it's based on price action over thesis. All my stocks, it's based on thesis over price action. I try to ignore actually what the price is doing and focus on the thesis, and then only use the price as sort of an input in terms of what do I think the risk reward is. Whereas with hedging, it's very much price action driven, because ultimately macro is super hard, and when it says can't, but it should say can change overnight in terms of the hedges. Like if the price action becomes, if the price action starts turning unfavorable, I'll start hedging. If it starts turning super favorable, I'll remove the hedges. So I actually increased it slightly today. But if we have another day like today, which market was up 2 to 3% today, then I'll be out of those hedges real quick. But it is now about 10% of the portfolio. I'm still thinking about it. I still enjoy thinking about macro, even though it's the reality is price action drives this versus whatever macro thesis I have. The reason why is because I can be wrong with macro, and B, like markets can go way different than whatever a macro thesis I have for a long term. That's very different, I'd argue, than companies where you're reporting quarterly results and it's like, look, there's a dynamic relationship with these companies where if the stock's just super cheap, they can be buying back the stock at a compelling valuation, and that's, ultimately pushes the stock price upwards. With macro, like, you could be wrong, there's not necessarily that dynamic that you get rewarded with. So let me discuss some of my macro concerns, and that's part of the reason why the hedges are there. That said, it's all based on price action, but some of my macro concerns is, I recently posted this two potential narratives. There's always one that drives the market. The one is that this market never stops until the Fed intervenes by either raising rates or reverse QEing, or what ultimately is potentially the new narrative. You started seeing it last week when several high-flying tech stocks, unprofitable tech stocks, took it on the chin, is that the Fed is losing control as rates start moving higher. And this which narrative prevails is a multi-trillion-dollar question. Whether or not the Federal Reserve will be able to control interest rates is this like multi-trillion-dollar question. And smart people have very different opinions on it. Case in point, Cathie Wood here, she, with ARK, she did an interview, just 2 days ago, posted on YouTube, where she's saying, like, look, the reason why rates are moving higher is because the economy is so hot. Things are just flying. And I think it's honestly more along the lines of what Ray Dalio has to say, where he takes a view of understanding the supply and demand dynamics, and literally several $1 trillion in stimulus is expected in the coming months. That's all going to be deficit debt financed. So how will it get financed? If you're going to be issuing literally several $1 trillion in treasuries to finance this, like, who's going to buy those treasuries to do it? Because, and this is where what Dalio does is he's like, well, okay, who are the bankers that are buying it? How much traditionally have companies, corporates, how much is coming from, taxes, how much is, so figuring out how the deficits, how the budgets are getting financed. So that's how he works, trying to understand, rates. And you can see how March 1st relative to February 1st, how this longer dated yield, 7-year yield, is 0.76 to 1.12, 10-year is 1.09 versus 1.45. These look like small changes, but from a price perspective, it's actually very big because it's the way bonds are priced. That's just an important point for you to consider. And so, I looked at today, and that's part of the reason why I increased my hedges, is I saw, look, rates are actually still going up at the back end of the curve. And that's this, for some reason the market, is rallying. But hey, this is based on price action, and I recognize things can go crazy for longer. And so, how will this get financed? There's a real risk that you have this supply-demand imbalance and rates continue to go up until the Fed announces that they potentially upsize their quantitative easing each month. So that's a real risk, and that's like the exact opposite of what Cathie Wood is saying, hey, this is, like, the economy's so hot, and people are just expecting the Fed to potentially, like, cutting rates. And it's really interesting to have this multi-trillion-dollar problem, where you have, like, effectively very opposite conclusions on it. And if high rates, I called out in the post, high new narratives, and if high rates become the new narrative, it's likely, I would expect that the market could take a real hit, and that's just something I'm super mindful of. And that's something I also called out in the journey, is that there's so many signals right now of just things being frothy, like margin debt just going parabolic, which is a real sign of speculative fervor of people like, yeah, I want to borrow money to buy these speculative SPACs. So just things to consider. Taking a step back, this is all part of my value proposition to you, the loyal Journey subscribers, where, I'm updating you on my personal journey, where, I do this monthly download. If there's any material changes throughout the month, I call it out. Otherwise, the smaller things, I'm just going to save for here, because, like, doing a 0.1%, it's generally not that big of a deal versus, like, hey, this is now a 3% position. And also, my main goal, and this is where I think most of the value will be over time, is the monthly potential multi-baggers, where, I'm trying to find these types of things that can go up hundreds or thousands of percent over time. Some additional things just to call out is I'm going to tweak the catalog of contents, hopefully make it a little bit easier to navigate around. I might use like a Google Sheet to do that, and a PDF folder that will have all the prior posts, so that way it's easy, one little link for you to click on to see all my my portfolio updates for each month, because sometimes people have trouble finding the PDF in this post. And then I'm also thinking about doing the Discord later this month, just so that it's easier for people to track individual stock specific news in a channel. It's going to be a trial. Like if there's behavior that I don't like on there, I'm going to rip it off so fast it'll make your head spin. So that's my view with Discord, but we'll see. I just don't want something that's going to require more time for me to like make sure there isn't people like pumping stocks that I don't want to happen. I so far I'm very, very pleased with everyone's behavior, where it's like, hey, people are sharing thoughtful thoughts. There's no ad hominem, there's no character attacks. It's just like, hey, let's share, let's dig to the truth of these companies, and that's what this is all about. I'm looking for truth, thinking about valuation, and at the end of the day, I hope this is super helpful for you. I'm super grateful to be on this journey with you. Several of you do email me at journey@unrivaledinvesting.com. I apologize if I don't get back to you. My goal is to get back to every one of you, but sometimes it's impossible for me to do it, just with the flow of like, hey, do I make another video or do I respond to someone's email at 1 o'clock in the morning? And it's that sort of trade-off. And thank you so much for subscribing. Thanks so much. Feel free to reach out to me, either at journey@unrivaledinvesting.com or directly on Patreon. And thanks so much for watching.